Bitcoin spot volume down 81%. Since October 2025, CryptoQuant says Bitcoin spot trading volume has collapsed by 81% since October 2025, according to CryptoQuant analyst Darkfrost, who shared the chart through Cointelegraph on May 27, 2026. The reading lands with BTC at 75,889, down 1.07% on the day and 1.78% on the week, and a fear and greed index of 37, firmly in fear territory. The number is striking on its own. Spot volume is the cleanest measure of actual buyer and seller participation at a given price, stripped of the leverage and rebate dynamics that distort perpetual futures activity. An 81% drop is not a quiet drift. It is a collapse in the number of dollars changing hands for real coins. The CryptoQuant reading Darkfrost's framing is straightforward. Spot is thinned out while futures and derivatives still dominate flow. CryptoQuant's chart covers the period from the October 2025 local high through this week, capturing both the late 2025 distribution phase and the slower 2026 grind that pushed BTC from six figures back into the mid-70s. The methodology matters here. CryptoQuant aggregates spot volume across the major centralized venues it tracks, so the 81% figure reflects what those exchange order books are actually clearing. It does not include OTC desks, dark pools, or unreported flow, which means actual all-in volume is probably less compressed than the headline. Even with that caveat, the trajectory is the point. Thin books show up in price action. Low spot volume changes the character of a market. With fewer resting bids and offers, a given dollar of market order pushes price further. That is how the $75,000 break earlier this month wiped roughly $100 million in long liquidations inside an hour. And it is how single-block trades like the BlackRock IBIT $1.3 billion print can dominate the day's tape. Bitcoin is now trading in a regime where order book depth is the variable, not the constant. Two things follow from that. First, the gap between published price and the price you can actually fill at size widens. Second, the influence of derivatives on spot increases, because the marginal price-setting order is more likely to come from a hedging desk than an organic buyer. This is also the backdrop for the 7-day ETF outflow streak that has pushed 2026 to the brink of net negative flows. The two readings are connected. When the largest passive demand channel turns into supply, the spot books that absorb it need depth they currently do not have. The October 2025 reference point. October 2025 is not an arbitrary starting point. That month marked the run into Bitcoin's most recent local top and the peak of ETF inflows for the cycle so far. Spot volume in that window was inflated by both institutional rebalancing into the new highs and a retail re-entry wave that briefly pushed fear and greed into greed territory. The 81% compression measures the round trip from that participation peak back to a regime where most of the marginal flow has stepped aside. It is not a unique pattern in Bitcoin's history. After the 2021 cycle high, spot volume on the major exchanges fell by a similar magnitude through 2022 before bottoming around the FTX collapse. What is different this cycle is the structural overlay. The spot ETFs are now the dominant institutional access point, and their flows are public and daily. When ETF inflows stall or reverse, there is no second institutional engine waiting to replace them, because the over-the-counter and treasury company channels have been comparatively quiet. Public firms picked up just 612 BTC last week, with both Strategy and Bitmine sitting out. Implications for the next few sessions. Three things to watch from here. Volume floor. If spot volume puts in a clear floor at current levels and starts to grind higher even at flat price, that is the first sign of a base. Compressed volume with rising volume is how durable lows print. Derivatives premium. With spot thinned out, the futures basis becomes a more sensitive tell. A flip to deep backwardation would suggest derivative shorts pressing into a thin spot bid, the classic setup for a violent unwind. Single prints. Expect more days dominated by one or two large blocks. The information content of any single trade is higher in a thin tape, which is why the BlackRock block earlier this week moved the conversation more than the actual size warranted. For active traders, the takeaway is that slippage and gap risk are elevated. For longer horizon holders, the more relevant signal is that price discovery has narrowed to a smaller pool of participants, which historically precedes either a capitulation low or a sharp re engagement when the macro backdrop shifts.